Hey, good morning, options traders, and happy Friday, everyone. Well, in times like these, it helps to know about CNDR and BFLY. So what are these things? Well, if they look like abbreviations for condor and butterfly, you're exactly right. But how do you use them, and what do they tell you? Well, these two are part of the CBOE's, that's the Chicago Board Options Exchange's U.S. indices list, and there's quite a big list in there. And the idea is that they are to give you an indication of the performance of short option volatility. Short meaning that you are selling these options trying to capture these excess premiums that we see during volatile times. So both of these, Condor and Butterfly, were launched in June of 1986. And the idea is the same, even though they're slightly different strategies. They are designed to measure the effectiveness of collecting out-of-the-money premiums. So let's start with the first one, Condor. Condor measures the performance of 1 month SPX, that's the S&P 500 index, short iron condors. So recall that whenever we have a short iron condor, we are selling options on a net basis. It's a premium collection strategy. It is a credit spread, not that that makes it better, but the iron part means that we are using calls and puts. And what it's going to do is to short the 20 delta strangle, which is the inside set of strikes for that condor, and it will be long the 5 delta strangle, which are the wings. So both of these sets are out of the money, right? 20 delta options are out of the money. It's just that the 5 deltas are even further out of the money. And so depending on what's happening in the markets, if this strategy ends up paying excess premiums for the wings, it will underperform, or if it turns out to have been a good decision, it will outperform. So this index is updated each minute, and it's rebalanced monthly, usually the third Friday of each month. Now the Butterfly BFLY index is exactly the same thing. And what it does is it measures the performance of 1 month SPX short iron butterflies. So again, exactly the same idea, but just with a butterfly, you're selling at the money. So for this index, the Butterfly sells the at the money strikes, which will be roughly a 50 delta, and then it still buys the 5 delta strikes. So whether it's using the Condor or the Butterfly, it is always purchasing the 5 delta strikes. So that's the real basics of the methodology. Obviously, there's a lot more of the calculations and details of it to that, but that's pretty much all that you need to know. But it can be very helpful for trying to figure out during which periods these premium collection strategies have worked. So let's go over to the CBOE's website and take a look at these two indexes. Okay, so now we're at the CBOE's website. That's just cboe.com. And probably the easiest way to find it is to come up to the search bar and just type CNDR, or you could also type BFLY, and it's going to bring you to a link like this. Here's your global indices, and let's click there. And there is the Condor. And so if we choose this link for performance, we can see long-term performance, and these little icons will show you some more of the historic moments throughout the market, some of the more volatile times that we've been in, to give you an indication of what was happening with these indexes. So another thing you can do is to compare them. So if you go up to this little box, click in there, and let's type BFLY, and we hit enter, and then compare the two. Now we've got both of them. So the Condor is on top, and the Butterfly is in black down here on bottom. So part of the outperformance for the Condor here recently, because you can see the green line is above the black. So part of that is because ever since this financial crisis, which is about when it started, 08, 09, that we've had more of the center strikes capturing that volatility, and the out of the money strikes, the very far out of the money, these 5 delta options, have had very big premiums in them. So if you're buying these for the Butterfly, that's actually going against the strategy. And it is here as well for the Condor. It's just that the Condor, because it has the wider center strikes, is allowing for some drift with the stock prices. But you can also see there's definitely been an upward bias. But if you look at them, I mean, even the Condor here in green is at about 677. So the index started at 100 back here in 86. So if we say that's roughly about 6.77 times that it's gone up over about a roughly 33-year period, That's only about 5.9% per year. So it's done okay, certainly not as good as the overall market, but it is also a limited risk, limited reward strategy. Now the butterfly down here has certainly underperformed. It's at about 442. So that's a multiple of 4.42 times since inception. And so for, again, this 33-year period, you're talking about maybe 4.6%. So those are two ways you can at least get a handle on how these strategies have performed, how they've done at various times in the markets when we've had exceptional volatility, and maybe give you some insights into which one you should be choosing if you're trying to capture out-of-the-money premiums. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.